The Hedgeless Horseman here. It's April the 14th, 2025. First of all, thanks to the sponsors. Two new ones here, Arctic Minerals, the Swedish listed copper silver play, and Tokwan Ventures, which is a gold silver play in Mexico. You can look into it yourself. I think that is a very interesting hodl potential in that one. Anyway, let's get going. I talked with the K Report guys today. We didn't actually record anything. I hadn't seen enough news out there, so I didn't actually have a a few good cases. And it's like, I mean, in terms of the ones I like the most, I mean, I've already talked about them quite a bit, right? So I don't want to just keep mentioning the same names, even though it's like again, the hodl folio doesn't, for example, or the best long-term cases, they don't really change that much. They're still dirt cheap. But we got to discussing a bunch of stuff off mic, which I think is very interesting, and I talked with a real life friend about this recently. I mean, it's kind of the, how would one call it, like the frustration that, well, and we talked about that with or I talked about that with Corey and Chad. We're discussing this thing where it's like the gold price is where it is, as you know, and that would be 3,230. So all-time highs, pretty much, over 50% higher than the last all-time high made in 2011. The main frustration for people, of course, is that the junior sector has not seen anywhere near the inflows one would expect. If somebody asked me 6 years ago, it's like, how much do you think the juniors will be up when gold is at by far new record highs? The margin in the gold sector are way higher than 2011. So the best anybody has ever seen, basically, that's still in this space. I would obviously think that a lot of these juniors would be up 5 to 10 times at least from where they are today. That's not a rounding error. That's a huge difference. Not that every junior should be up that much, because most projects or most juniors have projects that are shit or won't find anything worth mining, yada yada yada. So that doesn't change the number one rule, which is that most juniors are de facto worthless, because at the end of the day, they're not going to have something that gets monetized. But the ones with legit projects, the ones with legit shots at legit projects, which have stories that have not been killed yet, like exploration stories, they should be up a lot. They should be pricing in the potential, etc., etc. Even though, yes, if you're an early stage discovery story, it doesn't really matter if gold price is at 3,200 today or 2,000 if they're set to be in production in 10, 15 years. But that's the closest thing we can come to the future gold price, is the gold price today. And the idea is, or what gives people to want to, let's say, give up in a sense, especially in the junior sector, is that, well, at face value, it doesn't matter what the gold price is. It doesn't even matter what the gold sector is. I mean, how high the margins are, because they're not pricing that in. The juniors should be at all-time highs, let's say. They're not typically on a per ounce basis, even though the per ounce value of gold production specifically is at peak record. I mean, some of these ounces that are being produced have over $1,500 in margin. Why are even the advanced gold plays pricing in a $50 per ounce? Doesn't really make sense. I mean, they did that probably when the margins on gold ounces was like 300, but it is what it is, right? And this kind of fear is like, well, it's never gonna change, yada yada yada. that's what people are worried about. The fear that nothing is going to change. That it doesn't matter, they're going to stay cheap forever. And then let's imagine that the gold sector fundamentals rolls over. They could even go down. If you have the same discount, same sentiment discount, and the margin on the average gold ounce goes from $1,500 to $700, they're going to get cut in half, let's say. That's a fear people have. One thing, again, I would like to point out how many times do you think gas sector has been at historically cheap levels? Well, by definition, that's only this once, right? I mean, if it's the cheapest, let's say, ever, it means it has never happened before. So all other times, basically in history, it's always traded at higher valuations. So it's an anomaly by definition. It's a generational, let's say, anomaly. So again, how long do you think that would last? Will it forever last? Well, it's never lasted. Again, it's never happened before. So that kind of gives you a sense of how often a sector is that out of whack. But if we just look, for example, Endeavour Silver, I don't know it that well, but it's been around for quite some time. It's a producer. And everybody, as always, says that, well, you can't really make any money in this sector, yada, yada, yada. I would just, again, like to point out that even though I don't own Endeavour Silver, I owned it down here when it was really cheap. I wish I bought it at this low. I wish I bought it at that low. I wish I would have been around to buy it at this low. Because it went up quite a bit. Anyway, if we just look at the facts, okay, this company's, changed over the years, of course. But if we assume this is somewhat of a reflection of the average producer that's still around, kind of an optionality bet because it's never been really, low cost ounces, let's say. Let's just look at this peak here. All the buys within this blue box would be in the profit. So if you spend years 96 to 2004 years averaging down, you would make profit, be in the green on every single buy, and by quite some margin, especially if you average down. Then it peaked, and sometime later, or it went down. It peaked and went down. Then sometime later, at the next big euphoric sentiment high, every buy in this box here was in profit. Okay, then it crashed big time. Went down from 2011 to late 2015, early 2016. Then it turned around. At the next high, all buys within this blue box would have been in the profit. So the only period from 1996 to 30 years later, or 20 years later, you would be in profit. Okay, that peaked, down again we go, and this new high here, when it reached this price, every single buy anybody ever did and just held would be in the green within this blue box. So the only buys anybody could show a loss on still would be if you bought just this high. Then it went down, and of course this flips around. So when it went down here, every single buy above this blue line would be showing a loss, which is still most of the time since 1996. And then we are at a new, somewhat of a new high. We do the same thing. Only these buys would show a loss, and only these buys show a loss. So 80% of all the buys before this would be at a profit, and every single buy in the downtrend before the next peak would be at a profit, right? And even from from here to here, that's 300. I mean, not miraculous returns, but very good ones. I mean, if you have 1 year and whatever and get 72%, that's still great, and it just goes higher the lower you buy, right? And from this level here, 300% in just a year, absurdly good returns. All right. So at face value, yes, even in trading sardines kind of production stories, as long as you buy cheap, or as long as you can buy downtrends, you're gonna end up making money. That's evidence A. How, I mean, you could theoretically, I mean, if you're just good at buying low, which is almost the only thing I'm very good at, you're gonna end up making money sooner or later. It's just that, I mean, take this level here, for example, or we could take here. It's like, okay, anytime since 2003, if you started buying Endeavor Silver at this level and averaged down, the more down it went, in a not too distant future, you would have made money every single time. If you bought the lower it went, sooner or later you're back here, and if your average is here, you'll make money. Same here, same here, same here, same in this whole time here, same with every single buy down here, and all the way down, yada yada. So we really don't have necessarily any excuses not to make money long term in a sector this dumb. This is human psychology. The long term fundamentals don't change this much. It's like every single top and the bottom is a black swan event. That's how dumb this sector is. Of course, if you started buying here and you didn't average down at all, you're still at a loss, right? And a lot of people got in this sector 2020 to 2021, and they refuse to buy more because they're not in the green. They want to see that their portfolio is in the green before that the strategy is working. For example, if I started up here and bought, and all else equal, I would be down 77%. If I just average down somewhat to this low, I shouldn't be, let's say I'm down 50 or 60%. Already I would be up in the green at this point in time if I could just average down, buy when it's cheap. And I don't necessarily know how cheap this was, yada yada, only talking from almost a contrarian perspective, I guess. This sector is forever cyclical, and the funny thing is, again, now people are afraid it's never going to change. So if that's a fear, right, that it's never going to change, the gold price is going to go down before the juniors even fill the gap. Is that a possibility? Of course, everything is a possibility. Apparently, it's even a possibility that gold in the ground is selling for this cheap when the gold margins are record highs and the gold price is record highs. So anything can happen. But how does that affect? I mean, theory and fears and all that is like almost pretty much worthless unless you can actually put it into practice, let's say. I mean, what do we do with this information? We know there's juniors out there. Well, Agnico has gone up, for example. Alamos Gold has gone up, and it's like record highs. Lundin Gold is at record highs. There's, stores like Snowline Gold is at record highs. So there's stores that are at record highs. And that has to do with their fundamentals have improved so much that even with the same sentiment discount, price or value runs away so much that even if you use the same sentiment discount, I mean, if you had 1 million ounces and you were trading for $50 per ounce, let's say you had a 50 million market cap. If you 3 years later have 1.5 million ounces, you should be trading at 150 million, right? Even with the same discount. Or 150, what am I talking about? 75 million, right? That's still 50%. 50 to 100 and, I Okay, my math is completely off here. Let's say you had a whatever 100 million market cap, you had 1 million ounces. 3 years later, you have 1.5 million ounces. You should be trading at 1.5 or 150 million with the same sentiment discount, the same price per ounce. But yes, accounting for dilution, maybe you're only up 25 or whatever. Not huge returns, but still 25% in a shitty sector environment. That's not bad because we're not even talking about what could happen in a bull. That's one thing. So it's like the way I see it, you have this kind of fork in the road, or it's like Schrodinger's cat scenario where you could get fearful enough that it's never gonna matter that how valuable the ounces are. Okay, so if you have a trading sardine, that's never gonna be worth more than it is now because that it's a mature trading sardine. It's not gonna go higher on a per ounce basis, and they can't find many more ounces. Basically, you're betting at this cyclicality not happening again in our lifetimes. Basically, is that a long shot? Of course it is. It's never happened before. Would I bet on this sector never going up? Absolutely not, because it's never happened before. With that said, the problem with shitcos and optionality plays, why I'm not in any shitco optionality plays anymore, is that time is your enemy. Because they dilute, the management draws salaries, there's no way to make the project better if it's a mature trading sardine, yada yada yada. So the longer it takes for the greater fool theory to play in, for the momentum for the masses to get in, you're diluting away the value of your share count. And that's a monumental difference from a company that's raising money and creating money. Or creating value, I should say. They take in $50 million, they create 60 million of value. Not that the market necessarily per se, depending on the sentiment levels, is going to give that all that credit, but it's still going to go up in value. So if you have that sentiment swing, you're going to make even more compared to a shitty company who has not created any more value. And if we look at Barron's Gold Mining Index over 100 years, there's not a single downtrend, no matter what the narrative was at a time, that did not end. This sector has always rallied from bottoms, always rallied. Typically, the bigger the bear, the higher in space, I mean, in a sense. From this low here, huge, obviously. And this was a monumental rally, and that peaked. And the bottom here was the 2000s IT bubble. I've shown you probably before the Nasdaq to the HU index, and that hit the same level. Nasdaq outperformed in the same way as it did when it peaked around here. That was the start of an 11-year-old bull in gold miners. I wouldn't be surprised if we started that, because this happened last year, so I wouldn't be surprised if that's true, that we started a bull. It's just not, the masses haven't come in yet. So it's like, what makes sense? Should you, knowing the fact that there is a scenario where, I mean, if we take it to the extreme, yes, there's a scenario that the ounces in the ground are never going to get valued higher. Okay, how do you rectify that in that situation? How can you shield yourselves from sentiment in a sense? Well, for example, I have a private investment that's up quite a bit, and that company's never been cheaper because the fundamentals have never been better, and the metal prices went up since I bought the stock. So let's say I'm up 300% in that one, but the fundamentals went up more than 300%. So it's actually maybe even cheaper now. That's obviously a beautiful hodl story in a sense that you're up 300%, and now it's even dumber in one way to sell it. So it's kind of easy to, just keep hodling. I mean, that's what you want in a hodl story, really. It's like the fundamentals keep crawling up over the 5-10 years or something, and it's never really overvalued. So yes, it's just if it stays at the same cheapness level, if value goes up And if it's always cheap, share price is still gonna go up. It's just that it's gonna have the same discount. Because let's face it, I mean, if value goes like that and it was selling for, I don't know, at a 50% discount or whatever, if it keeps that discount, it's still gonna go up, but it's just gonna close this gap. But we don't really need to sell unless it reaches the actual value. This would actually, I mean, especially if it goes even higher, then as a value investor, it's like it's actually overvalued. But then you made a shit ton, obviously, and you made a lot of money just in this short period of time, perhaps, that this price to value gap closed because sentiment got better. So that's kind of the easy money, the money in your back pocket kind of thing. And this again, this is not fundamental. I mean, this was Endeavor Silver was probably overvalued here, but it went up because sentiment went up so much. Same here. This probably made absolutely no sense. There's nothing rational about this stock price being down here and then up here, except that sentiment changed that much and flow of funds changed that much. So you could have, I mean, completely in a sense give up on the optionality plays, or that ounces will be revalued, that you think that it's never going to matter what the gold margins are or anything like that. Given where I think those units are trading, that would be probably selling them very low, multi-year lows. Then you obviously have the problem that sentiment could change at any point in time. Nobody has absolutely any idea when the market was the most convinced a rally would never happen in the near future, as it were back here or here or here. This is the peak. This is the market with its pricing, voting with its feet, voting with its money, that since this time here, the market had never been surer that there was absolutely no chance of an imminent rally. And then it rallied. I remember these times. It felt like nothing could have this sector go higher. Absolutely nothing. It's like it had a huge anchor weight it was carrying around, and nothing's going to make this go up. All of a sudden that changed. Same thing here. Just flipped on a dime. Came out of nowhere. Well, it came with a Fed's first rate increase, then gold went up, silver went up, and they just lit on fire. And when there's enough of a good uptrend, everybody starts piling in, because let's face it, nobody actually cares about fundamentals in the short term. Everybody and their mother is a short-term focus, so they want to buy what's going up, or has gone up, I should say. Everybody wants to buy what's gone up. The big money is obviously to be in before it has even gone up, and when the people who only buy what's gone up start piling in. This was a 420% return in 8 months. And again, all of a sudden, went from almost every buy being at a loss to most buys being at a profit. That quickly. So with that, knowing this, okay, optionality plays have been hammered. They're very lowly valued. We know that alpha plays, the ones that work, can perform even in poor market conditions. The snow lines, the Great Bear from time to time, Collective Mining recently, Founders Metals, for example. For sure there are stores that can do well in bad times. But if the sentiment switch tomorrow, it's like Lundin Gold, which basically looks like how one would have thought gold units would be trading. If somebody described what happened to the gold price, I would think this would be the chart of a gold unit. And note this long ass consolidation here. Okay, gold price kept bouncing at $2,000 gold throughout this entire period, or meeting resistance, selling down. And this short trended down, which kind of made sense because inflation was creeping up. So every time gold hit $2,000 again since 2020, the costs were higher and higher. So the margins went lower. And that's kind of reflected actually in the share price of Lundin Gold. Then it broke out and the inflation didn't keep pace. So the per ounce value of gold being produced went up. And that we can see that in the Lundin Gold share price. But it also had this technical, this is just traders being traders. You have this consolidation period. Probably value went up, but it's like profit taking, yada yada. Then it broke free again, and then it's kind of gone exponential. And with gold hitting 3,250, this is basically what I would think the gold juniors would have done. Consolidated, actually made sense if they went lower from 2000 to 2024. But not as low as they've done, and the difference is that they haven't really followed this move up, right? So again, what happens if gold hits 4,000 and sentiment goes up? Well, Lundin Gold is going to probably go up much more, but if at any point the junior sector wakes up and it starts to close the price to value gap, even to get back to historical averages, or even pricing in parts of what the ASIC margin is per ounce, they would go absolutely ballistic. So if Lundin Gold would go up 100-200%, some gold units could go up 1,000 to 2,000%. But if that doesn't really happen, and gold just, let's say, creeps up and sentiment doesn't really change, Lundin Gold would still be making more money and could still kind of climb. So then you're looking at even more, let's say, you lost out on, if you know what I mean. So that's the Schrödinger's cat kind of situation where you have stuff that's absurdly cheap. You have trading sardines that are not really cheap because they probably are trading sardines, but they're still very lowly priced, and we know what happens when this sector gets going. And that could happen at any point in time. Nobody's going to ring a bell. It should. We've never seen it this cheap, so basically, by definition, one should be fearful of that up leg starting at any point in time. Okay, so what do you do as an investor? It's like, do you assume that this is never going to change, or when it changes, maybe it's going to be too late, so the gold fundamentals, the gold business fundamentals will have turned down, going into a bear market? Well, it's going to go down quite a bit if you go from $1,500 ASIC margin to, even in 2011, I think it was like 500. So it needs to drop by 67% to go back to what it had at the 2011 peaks. But that's just to say that the margin of safety is absolutely bonkers in some place. The way I like to see it, that's why I'm also invested in copper, nickel juniors, etc. Not only gold juniors, I'm also in silver juniors. Is that I'd rather be somewhat right than exactly wrong. But I've also talked about before that I prefer the hybrid, especially times like this, the hybrid all-weather portfolio approach, where my preferred cases right now, from a risk-reward perspective, is the ones that have something already that is ungodly cheap relative to what they already have. And then I get all the exploration potential for free. Because that's kind of a rigged bet. Unless the sector becomes absolutely dog shit or something very specific happens with some company for some unknown reason. But if you have 10 to 20 of those, there's almost not a chance you're gonna lose money. Unless we have much bigger problems than the stock market. And in that case, it doesn't really matter, right? If the world ends, it doesn't matter. It doesn't matter if you had Nvidia or a cheap gold junior. So the way I like to, again, I'm not going to get anything exactly correct. If I knew the sector was going to turn on a dime tomorrow, the sentiment, we had started the sentiment upwave yesterday, I would want to be, in a sense, from bottom to peak, if it happens in a quick order, it's going to be, absolute shitcoats that probably are going to go up the most, because they start from a very low level, even if they're worthless. They form these really nice looking uptrends. People are going to see 300% moves, and then everybody else is going to pile in because they think there's 300% moves left. So that's going to ramp it up, so everybody has like 1,000% returns. Sooner or later, that's going to peak. So yes, if I knew that was going to happen tomorrow, one would be in the, greater fool kind of place, because that's not going to happen. Lundin Gold is not going to 5 or 10 bag in 6 to 8 months. Very low chance of that happening. Some shit codes certainly can. But then you're also, again, exposing yourself to the risk that it's not going to happen. It didn't start yesterday or won't start tomorrow. And the, let's say, poor management teams are kind of going to keep destroying the value, if there is any value to begin with. And the longer you wait for the sentiment upturn, the less you will have for the sentiment upturn. They will have diluted and eroded, maybe actually created some problems, run out of cash, what have you. I don't like that approach much, because I don't want my only win condition to be a sentiment upturn. And how do you get away from that? Well, that is alpha creation. You can bet on exploration stories, some developer stories, yada yada. Where it's like you think that I like to see it. I like to invest or pick companies like it's a bear market, but have the conviction like we're in a perpetual bull market in a sense. My simple theory is that if a company creates enough value over, let's say, 3 years, somewhat of a hodl case, it won't matter if sentiment doesn't get better. If they create 300% of value, I'm going to probably be up in that stock. If the sentiment gets better, I'm probably going to be up a lot in that stock. You can't say that for trading sardines, of course. So that's just my preferred way to go about it, because I'm not banking on the sector turning anytime soon. But I see a lot of people in failed cases, shit codes, pretty much bad, let's say bad cases. And it might be, might be for whatever reason. But it's not obvious that they can create a lot of value if the metal prices just stay the same, yada yada. Or let's say the silver units, because they're most popular from a greater fools trading perspective. If you assume silver is going nowhere and you own a shitco, why should you make money on that? If sentiment doesn't improve, you're not going to really make money on that. So you're only betting on someone paying more for that shitco than you. And you have to make sure you survive and can stick in it until that happens, and nobody knows when that will happen. I'm not comfortable in those cases. That's the easy part. But what I would like to show how extreme this sector is right now, this is from Gerd Goggin. He's showing Newmont share price versus all-in sustaining cost profits per share. So it's adjusting for share count. This was 11th of April. That's Swedish pronunciation. This is that red dot. Here you can obviously see the scatter plot is kind of clustering. I mean, at points like this, one could say it's like over fair value, let's say. Let's say the red line here is fair value. A regression line. So here's kind of cheap. Sooner or later you might end up making profits, but I mean this does not factor in, of course, that the gold price, if you buy it here and it's cheap, at today's gold price might turn around, the gold price might go down, inflation might go up. Doesn't necessarily mean you're going to make money, but it's just a way to show when there's maybe too much pessimism, when Newmont is cheaper based on today's gold price and margins than it tends to be. This is obviously an anomaly. I wouldn't be surprised if most of these dots were around, I don't know again how often it's updated, but I'm guessing it's in kind of modern times, let's say. So now it's obviously very, very undervalued historically. So this, as I said, this is the golden anomaly. How often does this happen? Well, we can see it doesn't happen that much because 80% of the time it's spent here, and sometimes it's more. I mean, this is kind of the same overvaluation as this is undervaluation, and this happened, once or a few times up here. All the other times in history, it was not trading that richly. So it's an anomaly, even the gold producers, interestingly enough. So, I mean, at face value, even Newmont is kind of a buy here. I mean, if it's supposed to be at, I don't know, $90 per share or something, and it's trading at $50, that's quite some upside, even in a major miner. But it's not absurd upside, right? But it's I mean, unusually, it's like historically good upside at face value in Newmont. But let's look why I'm in juniors. If majors are cheap, I would say the gold juniors, risk adjusted, are ungodly almost cheap. I mean, truly historical levels. Truly where if they're so cheap that has never happened before, it means that the sector has never spent time being this cheap. So again, do you think that's going to last forever? What do you think happens when it does a mean reversion? Yada yada. This is from Ventum's, is it Ventum or Ventrum? Research report on First Nordic Metals. First Nordic Metals is today trading for 45 cents. And here you can see their different scenarios. And of course, I mean, nobody knows for sure, but they have to make some kind of judgment, right? Their downside case is, what is that? I don't know. I think it's like $1 or something like that. I'm not 100% sure if this is. Is this 80? Is it this one? I don't know. But the downside case is, let's say, 50 to 100% higher than what it's valued at. That's assuming that gold goes down to $2,000, drops $1,250, and you only price in 0.3% of the net asset value of Barsele. Maybe they included some value on the other stuff, but obviously not much if you have gold at 2,000 at a discount rate at 10. Think about how absurd this is. Their upside case is $3,000 gold, and what the actual net asset value is. So this is like, as best as they can tell, this is the net asset value of Barsele at $3,000 gold, 5% discount rate, which is, I was pretty sure it was above $4. Anyway, around $4, let's say. So like 8 to 10x higher. You realize how absolutely insane that is. This is lower than the spot price. Their blue sky upside case, which is orders of magnitude higher than these, is lower than where the gold price actually is. And it's still, I mean, discounting the cash flow and everything using 5%. I mean, it's absolutely bonkers. One would think that the base case kinda should be where gold is trading right now. And you have a downside case if gold falls, and an upside case if gold goes to $4,000. So in a sense, I mean, it's theoretically, I mean, some of these juniors are kind of rigged bets. That if the future is shit, you'll make 50 to 100%. If the future stays the same, you'll make 8 to 10x. If it becomes better, you'll make even more. What other sector do you think shows this kind of risk reward right now? Think about the 2015-16 bottom when gold was at $1,100 to $1,200. I think actually gold bottomed at $1,050. The projects at spot value were probably zero or negative. Downside case would be even deeper zero, and upside case would be like, oh yeah, gold goes up a bit, and these projects are actually worth something. Was that good risk reward? No, you had to kind of be a contrarian, right? Because you're buying something at the time that was absolutely worthless. Then metal prices went up and they were actually worth something at face value. This is orders of magnitude. I mean, it's literally ridiculous. So if we're talking margin of safety, this is the definition of margin of safety. And also going back to, okay, what happens if the market, if you're stuck in retail sentiment levels, let's say, how do you get around that in a sense? If you're paying dividends, it doesn't really matter. It's like the private company I talked about earlier, they're paying dividends. Pretty hefty dividends relative to the purchase price a few years back. It doesn't, if you're getting dividends, does it really matter what the stock trades at? Well, in a sense, not really, right? Especially if you're playing for dividends. Because I'm still making a shit ton of money on that investment I might have, purchased 3 years ago. And I'm, let's say, getting 25% dividends per year 3 years later. And, they have a growth profile as well. So in 3 years from now, I might get, 50, 60% of yield on my initial investment. Does it matter what the share price does? Does it matter what people value announce in the ground? Whatever. No, dividend, the margins it doesn't matter what the sentiment is. The economics are what they are. The gold price, silver price is what it is. So of course, there's a way. It's like, how do you punish a really cheap market? If you're in a trading sardine, if nobody's going to buy that, then the junior will never ever have the money to build it because it's not a great project. Let's say you have a trading sardine trading at 50 million market cap. They have a pretty subpar project, but at face value they have 2 billion MPV today. But it's going to cost them 500 million or something to put that into production. If the gold price stays the same, the sentiment level stays the same, and the subparness of that project stays the same, there's probably no one that's going to be acquiring that company because nobody wants to own it and build it. And if you're at 50 million market cap, you're not going to be able to finance it probably, right? So in a sense, you could be stuck in you could be stuck there. That could be stuck there forever, and there's no way of punishing the market in a sense. But if you have a actually good project or one that can get built, if you can build it, there's going to be more people willing to own it. From a producer standpoint, because a project that can't get built is worthless anyway. And if it's actually a good project, there's also a way you could actually finance it yourself. So then you could actually punish the market because, hey, if a major miner wants to pay $1 billion for it, it's trading at 200 million, they're probably gonna jump on that. It's like, take Rupert Resources, for example. Yes, they have a 1.2 billion market cap, but today's gold price, they have an NPV of like 4 billion. It's a good project, and every gold miner is, depleting their reserves. Is somebody going to buy that? Probably. Does it matter? If Agnico buys that, and they're willing to pay 1.6 billion for it. If Rupert is trading at 800 million or 1.2 billion dollars, and NICU is going to pay 1.6 billion dollars for it, you can't kind of punish the market by buying it at 800 million. That discrepancy is gonna bigger discrepancy is gonna make you make more money. So that's a third party, a kind of value force in a sense. Somebody actually acquires it because it actually has value. Or you have another option where it's like the internal growth juniors in a sense, where they might be, I mean, Integra is a good example. They actually have cash flow. So yes, let's say Integra stays cheap. That doesn't change the margins on Florida Canyon. And if they go to, in a year or two, it's like, hey, we want to finance Delamore. The bankers probably doesn't care that much about the shitty junior sentiment or what retail is doing. If they're seeing, hey, your asset Florida Canyon, which by then might have whatever, like 7-8 years left in mine life, if you're making 80 to 100 million EBITDA per year, I think you can get a bank loan on that. And then you could put Delamore into production. And then you might have 3 times the free cash flow when that's built. And that internal cash flow can be used then to build Nevada North. And let's say in 5 years, Integra is making more free cash flow than the current market cap per year. So in that sense, if you bought Integra when it was cheap, nobody really cared. If the market really doesn't care, can that be a profitable investment? Yeah, I mean, if you would get, I don't know, let's say 30% dividend yields 5 years from now. And what if gold price is even higher? And what if they made more discoveries? Maybe they've acquired another project which they can then also internally fund, which keeps on ramping up the future dividends. Then you can actually, then you're kind of punishing the market if it was too cheap today. But if you have no way of doing that, you're stuck betting for the sentiment to only change. But of course, the thing is, with stories like that, if sentiment changes, you're going to get share price appreciation instead. You're going to get paid quicker, let's say. But the plan B is that it at the end of the day, it might not matter that much what the sentiment is today. Because if it's cheap today, they have ways of punishing the market for making it too cheap. Or you, in a sense, or other way to look at it, your investment when you think the market is off is going to pay you literally maybe dividends. And if sentiment turns around, you're just going to make more money on the investment quicker. So in those kind of situations, there's plan A's and plan B's. And then, of course, there is the threat, let's say, of the gold price going down a lot, whatever. But that's also the risk reward. If there's a 100% guarantee of making 5 to 10x your money in 5 years, you would be all in basically, because you're not going to beat that return in anything. Not with a 100% guarantee. That would be safer than U.S. Treasuries, for example, which I would say are getting less safe. So there's ways to go about it. It's like, again, the all-weather approach. Okay, you have a developer store or something. Well, they have internal cash flow. In that case, they can increase the value of the business and actually increase the cash flow and per share count, which is much easier for them, or EPS, which is much easier for the market to look at. Because let's face it, if you have shitty sentiment, something is trading at a P7. If they double the profits, and the same sentiment levels are in place, it's not going to be trading at P3.5 because it increased its EPS by 100% over that period. No, if it trades at the same sentiment levels, it's going to price at a P of 7, which is going to be twice as high as when it only had one asset in production trading at PE 7. And one thing to note also, it's like, there's nothing really rational about this sector. Not. I mean, again, yeah. I mean, that's the way to see it. It's like I consider this sector to be. It was dumb in 2023. Got dumber in 2024. It's never been dumber in history in 2025. And this is what happened like 2015-16 bottom. One thing, just note this divergence here. At this bottom, gold was at whatever, 1100 perhaps. Down here it was 1050. This gold price is obviously higher than this gold price or this gold price. The GDXJ traded down here. Higher gold price, higher bottom. GDXJ did a lower bottom, which made absolutely no sense. And I remember this like it was yesterday. I remember cashed up producers like Silver Standard. I think they had, I don't know, 30% of their market cap in cash or something. It was down like 10%. And that day, silver, I think, was down, silver and gold was down 1%. So that was capitulation selling. Cheapest they've ever been. Somebody was selling that. Happily selling it for 10% cheaper than the day before, even though the fundamentals, gold and silver just went down 1% on one day. And that was the bottom. And then it went up. But you can see, okay, that went up. Let's see here. Let's say, okay, gold ramped. Here it peaked for the time being. Then GDXJ, I assume this is the peak here. Then if you fast forward a few months, gold price was at the same level as it was here, right? So all else equal, I don't think inflation could have changed that much. So business value wise, it's probably the same business value here as it was here. But look how the GDXJ went. So assume it's like, if we assume the fundamentals stay the same, the GDXJ should have flatlined. GDXJ went up here. That's huge outperformance. Does that make a lot of sense? Well, not really, but the sector rotation had started. People saw this run up here. And they started going in even more. And even here, you see like, even though, I mean, the gold price here wasn't much higher than here, but here you start seeing gap ups. 1 gap, 2 gap, 3 gap. So it was simply money entering the sector. And the more that happened, the greater the returns were from the bottom here, which got more people to buy. Then it's like another gap, another gap, another gap. Up here, people are falling over themselves to buy, and many producers were pricing in even higher gold and silver prices than spot. So you can imagine, again, if we go back to the situation in gold juniors, for example, or actually even producers, but gold juniors, I mean, at a sentiment high, in a bubble phase, one would be expecting that gold producers and juniors are going to be pricing in a better future than current. That tomorrow is going to be even better than today. And it's also already, I mean, basically pricing in more than the value today. So think about the delta going from today's discounts to a future premium one day. If gold fundamentals, gold margins stayed flat, and we would hit bubble valuations, they would be pricing, the gold units would be pricing in the net asset values of their projects at, let's say, $3,500 gold, which would be somewhere up here. Then you would have reached overvaluation. a market willing, they're trading at a speculative premium. Now they're trading at such a speculative discounts that I'm not going to say worst case scenarios, but the downside targets are higher than some companies are selling for today. That is an absolute absurdity. And again, given that this has never happened in the not that anybody can remember that's probably still alive, this is probably never going to happen again. This is an anomaly. Just a mean reversion could be good for a few X in some serious projects. Reaching an overvalue, the thing is, like, we never know when the overvaluation period happens. Gold, when this sector, and again, the bear case is it never happens. We're never gonna have a bubble or even high sentiment, which has probably never happened in history. So we're betting on something that's never happened, basically, that gold miners or juniors stay record cheap forever and they just flatline down here. Or flatline down here. That has never ever happened, as we can see. So that's one way to go about it. You think that this time, for only time in history, that's actually going to be a thing. I wouldn't bet on that, obviously. I mean, that has 0% hit rate over the last 100 years. If you want to bet on that, you're not backing that up by history or anything. It's just that this time it's actually different. Unlike every other time people thought the same. Yeah, and oh Jesus, I get it. Oh. But also think about this. We don't know when a potential overvaluation will happen. Okay, I would have thought it would be here already at new record high gold. Let's say it happens at $5,000 gold, so $4,000 gold, or $10,000 gold. And we actually have like margins above $2,000 per ounce or something crazy. Can you imagine how high the gold juniors will be trading at that point in the future, when we have an even better fundamentals, and we reach a bubble or overvaluation phase where they're pricing in an even higher gold price. So if this sector gets going and gold reaches 4,000 and the sentiment is really hot, then it might be pricing in $5,000 gold. Seriously, think about the delta. So the more people are kind of open up to the idea that this might never change, that it is actually opportunity cost. It's like you're betting that it's never gonna get revalued. The more I think that the future rally is gonna be even bigger, because it's probably never been more absurd. I mean, the fundamentals down here, when the juniors were down here, is probably maybe more absurd today. And this obviously was the best rally anybody had ever seen in quite some time. And this sector can go on absolute. I mean, this was kind of in a sense a bull market that lasted from, well, if you look at the low here, 1940 whatever, to 1980. So that's a 40-year uptrend with huge corrections along the way. I think the more people believe that it's different this time, and that's being reflected in the market, of course, because people are prepared to sell stuff cheaper and cheaper and cheaper, because they are getting more convinced that it's never going to go up. So you have your price going like that. Let's say share price going like that. What does that mean? That means sentiment is getting worse. The sector is getting more irrational, because this is an expanding price to value gap. So the cheapness is going exponential. So we're probably at the craziest this sector has ever been right now in terms of undervaluation compared to spot gold price, spot business value. And why is that happening? Because people are looking at this and maybe or somewhat aware of this, seeing it's not changing, which means that they believe more and more that it's never gonna matter. So it just keeps on expanding because more and more people are giving up for no other reason than regardless, even maybe because they see the price to value gap expanding. So they're okay with thinking that, oh, there's actually opportunity cost to be in this sector. So it all makes sense from a psychological perspective. The best buying opportunity by definition must be the times when nobody can see it, or at least act on it. When people are selling for no other reason than it's not going up. That's how you create some insane. It's the same with overvaluation. Was the sector overvalued in 2011? Yeah, I think most would say that. Kinross bought Redback Mining for $7.2 billion US. And later on they had to write down billions and billions of that value. But the idea was that, hey, this is going to keep going up forever. It doesn't matter what we're paying. So that's what happens at tops, obviously. So yeah, again, it's like talked about Integra. I talked about this quite some time. I mean, it just doesn't make sense. It really doesn't make sense. And the beauty for Integra has been that fact that if the market can keep ignoring the cash flow out of Florida Canyon and the fact that they have an even bigger project in Delamar and another project in Nevada North and exploration potential around all of those three targets or projects, they can ignore that today. But that doesn't matter if, in a sense, if they can monetize that, because that's going to have the fact that they have a pipeline like that, the fact that they have a free cash flowing mine, the sentiment doesn't change that. So they can ignore that fact, but that sentiment cannot change those facts, which is a beauty in a sense, because like I talked about it already. There's potential here that in 3 years you're gonna have 3 times the current production, let's say. In 5 years they might have 4 to 5 times the current production, and they might have ramped up Florida Canyon in that time. So if we're just assuming, let's say they do that, yes, they add some debt, maybe some equity, whatever. Let's say they do 500 million in free cash flow. I'm just making up a number here because we don't know what gold is going to be trading at in 3 to 5 years. Maybe $5,000. Do you think Integra is going to be trading at 387 million, or even 500 million, or even $1 billion? No, I don't think so. It's probably going to trade more like 2 billion at least, especially if the fundamentals of the gold sector is around where it is now. So in that case, it's like then you're actually taking advantage of how shitty the sentiment is, for example. But then of course the sentiment can pick up, and Integra is not going to be trading for whatever. It's going to be trading for 50% higher or 100% higher. You don't know. Maybe they've done some other acquisitions. Maybe they've had some exploration success. I can see a lot of things go right in a big way over the next 3 to 5 years for Integra, which is not dependent on the sentiment turning around. But you can't say that for a lot of trading sardines that have shitty projects, even if they have a project, can't put it into production, nobody's going to buy it. Then you're stuck at the mercy of the greater fool, the retail dude. But a company that can create value and or unlock value, regardless of what the sentiment is today, then you can punish the market, because even at the same sector discounts, if they created enough value, and they can create enough value, it's going to be trading at a higher price. Then the sentiment boost, the easy money from the greater fools, is going to be a bonus, not a requirement. And the sector is too effing dumb to realize that. So these are, I think, from some report on Integra, for example. Financial highlights: gold price at 3,000, operating cash flow 66 million, adjusted earnings per share 20, and this is just from Florida Canyon. 2026, 16 cents, and then they have, here we have some even. I mean, this is only $250 higher in gold. Operating cash flow 100 million. That's 2026, that's next year. And that's only from one asset. So they would be trading at, I don't know, 7 PE if gold hits 3,500 and stays there around 2026. And some Goldman Sachs and whatever thinks it's going to hit 4,000 before the year's over. And you can imagine, how if they're making that much money, you can imagine that they're probably going to have an easy time funding Delamore and funding Nevada North. Or if $4,000 gold happens. It doesn't matter what the sentiment is today. They don't need to build Florida Canyon. Florida Canyon is already there. So this could be the reality regardless of what the market is pricing Integra at today. And they could use that cash flow, which the market, let's say, is not pricing in, to build these projects in the pipeline. So this is at $700. Don't they have a? Okay, they don't even have a. Oh, yeah. Okay, they don't even have the sensitivity. So this is what, 450 million CAD at $1,700 gold price. And if gold is very high, they're probably not going to have a problem funding this, and it looks like it's going to get permitted given how the US is going. And then they have Nevada North. Any one of these projects, their NPVs at today's gold price is multiples of what Integra's market cap is today. So what if in 5 years they have 3 mines up and running and the gold price hasn't crashed? Yeah, something to think about. Again, that's the beauty of it. I don't want to be stuck in trading sardines where the future has to get better and I need greater fools trading sardines. I much prefer cases where if the sector goes to shit, I didn't overpay. If the sector is where it stays, I could make 10x. If a store like First Nordic happens to find 1 or 2 more discoveries, who knows? Maybe 20x. Because if we go into a and I'm not saying I would hold the stock all the way from, you know, up to 20x, but picture this scenario. It's like, okay, First Nordic consolidates Barsele. Barsele would be pissing money at today's gold margins. Let's say they prove up that Barsele is at least 45 million ounces. Let's say over the next 3 years they also find at least 2 discoveries with 1 million ounces each. Then you're up to 6 to 7 million ounces. Let's say they're pushing towards production, and let's say gold price is at $4,500. The sector has become hot. It's starting to price in $5,500. And these guys have a, you know, net asset value of $4 or $5 billion. And you put a sentiment premium on that. That's the kinds of moves I think, since nobody's expecting it, that's what I can see is in store over the next few years. And if you look in almost every company channel, 70% of the chatter is what the stock is doing today and what the stock might do tomorrow. I'm thinking what any one of these stocks could be at, let's say 3 years, and compare that to the price I'm paying today. And First Nordic, for example, Barsele is such a good project. That's not a paper project. As you can hear Tosh and Adam say, I mean, this is going to be a mine. It's one of the most de-risked projects out there. It's one of the highest quality projects out there, and the story has some of the highest exploration upside of any gold juniors. That is, and I don't, I mean, it's like, okay, look at this. Look at this. Let's see here. Can draw the line wherever. It's like, okay, oh, okay, yeah, maybe, I mean, maybe this is a back test, because there's a shit ton of traders all over these juniors. It's like, well, if I just draw a head and shoulders pattern here, for example, that's reverse head and shoulder. Okay, let's see, broke out here. Well, that's still a target of 73 cents, and that's playing it small. I mean, look at the analyst report. But a lot of people is like, yeah, a breakout always back tests the breakout. Sure, I mean, that's the thing. It's like, there's so many traders and everybody is so short term. That's like, a lot of the time makes absolutely no sense in the short term. That's why I kind of like, I mean, in a sense, I like traders, because they make stuff more expensive than it should be and keep stuff cheaper than it should be. Maybe this is a bull flag. I have no idea. But like, none of these moves really make sense. Like, what's so magical about this line here? Nothing. So my point is that, you know, you're seeing some sell orders here. It's like, I have absolutely, the only reason I can see anybody selling at these levels is if, because there are quite a few options and warrants out, that there's people who are in the story, they're converted warrants and options, and they want to, let's say, keep their position size the same, right? So they're selling some stock to exercise warrants, and there's quite a bit of them. And the same is currently happening, I think, in West Point Gold, for example. They're cheap, but it's like artificial in a sense. But the market should be, in my opinion, efficient enough that it should have no problem taking all this warrant, because this is almost, in my biased opinion, this is pretty much a crime. And in my opinion, everyone that has sold First Nordic to me, even at the tops here, the latest top, from a fundamental value perspective, they're out of their effing minds. And I know what my long-term returns are, so I'm just assuming not that every story I buy is going to prove to be working out, because I'm also in early stage exploration plays that I think are too cheap. I think anybody that's selling shares to me, I think I'm eating their lunch. That doesn't mean that that's for sure going to end up being a success. I mean, a recent example is like Headwater Gold traded at 10.6 million CAD market cap, 3 million in cash, earnings with Newmont, 12 projects in total, Centerra shareholder, enterprise value around 7 million CAD. I mean, that is absolutely batshit crazy. But there's still a scenario where they find absolutely nothing of economic value over the next 3 to 5 years. And I'm not going to be making money on it, not even at that level. Maybe I'll lose money. I don't see that's very probable, but let's say that yes, there is a scenario. And then somebody can say, ha, look, the guy selling it at 10.6 million market cap was smart. That's outcome dependence. To me, he's a fucking idiot, and probably one of the 95% who has absolutely no clue how to make any money in any sector ever. That's what I'm feeling like. Anybody, again, there's probably a warrant and option conversion here. So it doesn't mean that whoever is selling shares to pay for warrants and options, he's not batshit crazy. He can understand how absurd this risk reward is. He can understand the value of Barsley. He can understand that that's a tier 2 project that's going to become a mine one day. And has free optionality on tier 1 potential. But anyone else that's like, oh, the stock hasn't moved yet, I'm selling, or I don't think this sector is going up, it's like, they're just proving why I in my opinion, they're probably never going to make any money in any sector ever. Because if you can't appreciate the absurdity of the asymmetrical risk reward in cases like this, you shouldn't be investing. First Nordic is my second largest position I have. It's my largest gold unit position I have. Do I care if it's down 3.3%? It's like I have significant exposure in First Nordic. And I've had it's gone from high of 63 cents down to whatever. To me, this is still a rounding error. I'm not in this forum bitching, and I can point out how dumb I think it is. But my net worth on paper went down from here to here. But I'm in it for the delta of where the stock is down here to where I think it can be within 3 years. So this is an absolute round. If it's trading at 140, 150 million or 120 million, why should I care? If things go well, this is going to go to $2 billion, if things go well. I've seen this in a bunch of juniors where their intrinsic values are multitudes higher than where they're trading at, and still they go into corrections. And then people think, oh, and this is nothing to me. If I cared about 50% here and there, That I would do if the sector was very expensive, really, and I found something that was just cheap enough that I think I could get. Well, 50% was probably not being enough, but it's like, yes, if the only thing I could find is like, oh, I might be a 50% price to value gap here. Sure, then these ups and downs are material. But if you're looking at cases where the upside is 5 to 20x, this doesn't matter really at all. And then, of course, we can consider the fact, it's like, well, again, how do you punish the market in a sense? Well, as this report says, I mean, nothing even close to the value of Barsele at current spot price is priced in. That's the bird in the hand. That's just based on what they have already. So I'm not taking on a risk on that. I'm not hoping they have that. That's what they already have, stamped and worked by Agnico Eagle. So there's no red flags. They've done everything: the drilling, geological understanding, metallurgy, yada yada yada. So it's like this is the bird in the hand. At spot price worth 10 times almost what it's selling for. Then we have, what do we have? So that's the margin of safety at spot price. We even have a margin of safety of the gold sector becoming much worse, etc., etc. And there's still margin of safety even in those scenarios, which is rather unique. So is the shitty sentiment right now changing the fact that this is a tier 2 pro? No. Do I think there's a line of mid-tiers that would happily be strategic investors if they were able to, if Agnico was out of the picture? Yes. How many projects like this exist around the world today? There's only a handful. And before this year is over, if we're lucky, they're going to show that this might be a tier 1 project. And okay, they're trying to get this 100% as we know. Do I think that would be it's going to be a big problem? No, it's like the biggest quote risk is that Agnico sits on the project. Well, there's, I guess, two risks. One is that they simply put a bid in for First Nordic and put this into production themselves. I don't think they want to be funding. If they go to PFS and free carry First Nordic to a PFS, they want to build a project, and putting in 100% premium would be nothing. Obviously, it's like 240 million CAD for something that they're at spot price. Their 240 million CAD is actually worth, like, I don't know what this is worth, but let's say 900 million or whatever. Obviously they're stealing the project anyway in that case. But let's say, okay, if we're talking like that actually could weigh on the stock in a sense, yeah, that would be Agnico sitting on it. But Agnico sitting on it and the sentiment of them sitting on it doesn't change the fact that they're drilling 25,000 meters plus this year. And I'm assuming they're getting warrant and option money in right now, so they can drill even more. So what if they make another Barsele discovery, etc.? Then it's gonna, this is a tier 1 project, and even Agnico Eagle would want it. And that's happening regardless of if Agnico Eagle is slow at Barsele itself. And then then something for I think for sure is going to change, because if we're seeing Agnico having to go to Colombia to find a tier 1 scale project, that's saying something about the lack of tier 1 projects in their preferred jurisdictions, which is North America, Australia, and Scandinavia. And as we saw recently, they are back putting money into Ikkari. Has Ikkari changed that much since they didn't invest in the last round? No, not really. Well, except for gold price being a lot higher, and they're probably figuring that, oh shit, even at this price, Rupert is cheap and there's not many projects, so we better we better fill up the pipeline while we can, because there are not that many projects in tier 1 jurisdictions, which Agnico is getting a premium for. Yeah, this is the research report. Another one, Magna, classic example. It's not the same situation because the nickel fundamentals or copper fundamentals are not as good as the gold fundamentals. But you have the kind of a similar story with Integra. So what the sentiment is right now? I mean, if Magna can pretty much self-fund their own growth, and they have ton of growth, if they execute on their plan over the next 3 years, do you think, even with the same metal prices, let's say, if they have 3 mines up and running within 3 years, maybe made an acquisition or 2, which is going to be easier, obviously, if the sentiment is poor, maybe they don't have to pay up as much. Do you think the market cap is going to be the same if they're producing 3 times, let's say, what they're producing now? I don't think so. What happens if nickel prices turn around and go up, and if copper prices keep going up? If they 3 times the production they have today? They have 5 to 10 year plans. This is a hodl case if I ever saw one. They are not looking really for an exit. They're looking to grow for 10 years or more. The optionality, well, if they just execute, you're probably going to make money in Magna from here. Maybe quite a bit of money in the next 3 to 5 years. If metal prices turn around as well, you can maybe add a multiplier to that. From doing absolutely nothing except letting management execute. And typically a better management team, the more time you give them, the more value they create. The more the delta is from the value of, on the day you paid for a share, which is, let's say, today, or if you hold it today, if you give them 3 years, they're probably going to create more value compared to today than if you give them 2 years, etc., etc. Altamira Gold. This is just another, I think, classic example of how the sector works. So they put out a news release. Altamira Gold expands the Cajero district potential with new discoveries of porphyry related. So they have some at Tavares North grab samples returned an assay of 7.8. Seraphim grab sample of 5.6. Guillermo trenching showed 35 meters of 0.5 grams per ton. Obviously that's at surface because it's a trench. The Cajero picture is, there's a lot of low-hanging fruit here, let's say. So this is the new Guillermo, Seraphim, Tavares Norte. Is there some potential, here you have the scale bar, is there some potential in this picture? And since it's grab sample, obviously near surface, potential, trenching near surface potential. They already have 700,000 ounces of gold. Not a PA out yet on it though. Morea Bonita discovery, Novosonios, I don't think that's been drilled yet, Mombaque, etc., etc., etc. Yep, okay, so they're showing there's even more potential now. They have three additional targets of interest, which means upside potential, discovery potential. And I made a tweet, it's like, I'm not surprised at all. It's like, why is the market not reacting? Well, the market is only focusing on one thing right now when it comes to Altamira. The fact that regardless of how much potential they show, regardless if they just show that, there's good chance there's gonna be, 500,000 of near surface, I'm not just making a number up now, near surface potential oxide ounces. The market focuses on one thing right now. It looks at the cash position of Altamira and the fact that there's no drilling going on right now. So that's kind of the gatekeeper. You see this in junior sector all the time. There's no risk, really, in a sense, of getting rich tomorrow in Altamira, except somebody comes in and takes them over. They're painting, okay, now they're up to whatever amount of targets right now. And the market is like, I don't need to care about that right now. Because I think the next other material news release is going to be, or I should say like this, regardless of the potential you're showing me right now, there's not enough retail buying to price that in, apparently. And that's not exclusive for Altamira. And the only way you can show that this is a legit new discovery or what the potential is in these projects is that if you drill it. And you can't drill it until you raise. So that's what I'm focusing on right now. So it doesn't matter how much long-term potential or upside potential you show. You can't prove that except if you drill. And if you drill, you need money. That's what the market is. That's why I keep saying it's like this sector. And in this case, it's kind of somewhat understandable because it's like pretty obvious that they're not cashed up right now. But this is a bit like, being an insider. Because they de-risk, they do work, they show it's like, hey, there's more potential on this project now. So obviously the implied value of the project at Cajero is going up. But you don't have to pay for it because the market is not pricing it based on that. It doesn't give a shit really about these targets, by Mr. Market, because it's not pricing that in. It's just focusing on the fact that it expects Altamira to do a financing. And imagine if Altamira had, I don't know, 10 million right now and could start drilling all these targets. Yeah, then it would be a different thing. Hannan Metals, they recently, I didn't think I talked about this, pretty impressive, L2. I wrote them up quite recently. So it's like, yeah, they're kind of confirming the case. Extended mineralization at Peristo, Peru. So this is the gold project that's now up to entire channel, 135.2 meters, 1.3 grams per ton AU, 9 grams per ton AG, and tellurium as well. And encompasses the previous high-grade hit. New high-grade mineralization, so they found 11 meters of 0.37. I mean, since it's channel sampling, that's right at surface, and 2 meters of 18.8, which is bonanza grades, and a new outcropping copper mineralization, 35 meters from the gold mineral, which is kind of interesting, and I assume this is leached. So whatever the grades were in this mineralization when it was fresh, it's probably been, rusted away in a sense. 6 geologists now actively conducting so again, this is kind of, it's just playing out that they're going to be de-risking this more and more. 6 geologists out in the field, they're doing, so I would expect this to be de-risk, because I think in the eyes of the not only the market but the company that the Peristo Gold target is the flagship project, so they're throwing a lot of manpower on this. And it does still not change the fact that they have all these, 5 or 6 targets, I think. I don't remember exactly. I have it in my in my article that they're also going to be testing. And I think that's, I think you could it's not maybe the cheapest stock out there if you just look at the Peristo Gold target, but it's an absolutely immense target. So one can understand why at a gold price of today in this sector environment, where a tier 1 exploration target has 172 million market cap. So it's not, I don't think it's wild given the size of it and how promising the early trenching is shows. But they have a bunch of other potentially company making projects as well. So I think, again, you kind of get those for free, because I am just regurgitating the case I laid out, where it's like you can't kill the Peristo target. I mean, if anything, I assume it's going to grow because they're going to be de-risking it. Of course, there's a possibility that they go out and channel sample and they don't find anything. How probable that is, I don't know. I mean, it's a huge soil anomaly, so it suggests that there's gold in a lot of places. Yeah, but again, it's like, if anything, this is just kind of, for the de-risking the previous gold target. Yeah, and this is why, again, I mean, if the Priesta gold target turns out to be a tier 1 alkaline gold system, a new Cripple Creek type thing, it's going to be valued higher than it is today, maybe a lot higher one day. If they make some drill discoveries as well, it's just going to get bigger. And as we can see, I mean, tight share structure. Who knows? Maybe there's going to be fat strategic investor coming in. It's like, you never know. I mean, usually, again, just look at Altamira, which we recently talked about. Since Hannan isn't that cashed up right now, but it doesn't seem to bother the market. I don't know. Maybe it's like, I would think that if tech funded them before they had all this potential, now tech is not primarily a gold player, but you can imagine how many probably gold majors are also looking at the Priesta gold target, and most gold majors like the copper aspect as well, I would think, today. So I think there's quite a bit of demand, let's say, for Hannan, because there's not many. I mean, if you find a soil anomaly this big and get a trench like this, and it's an alkaline gold system, it's like, that's suggesting that there's potential for this to be one of those rare, huge alkaline gold deposits that's kind of flagship mines for a lot of these gold majors, and there are not many of those around at all. So if you think there's a chance that you might have one here, yeah, that's going to bring a lot of demand, I would think. Anyway, I talked a long time already. My throat is starting to hurt. As always, not investing advice. Consider me biased. Every stock I own, I'm biased for it. Every stock I don't own, I'm naturally also biased against it in a sense. Don't consider this investment advice. Juniors are risky. Don't invest money you cannot afford to lose. I have no idea if anybody's going to make money or lose money on any one of these stocks. I don't even know. I have no idea what they're going to be trading at in a year from now, or even a day from now, or 5 years from now. But at least, you have a sense of, again, the risk reward I see. And it's like, if every single one of these played out along the lines of base case or blue sky, I mean, I'm probably going to make a lot of money on them. And if some fail, if some turn out well, I mean, they're going to cover the losses in some other stories, etc. You get the point, I hope. Thanks for listening. Bye-bye.